bit chilly today, but we're still enjoying the day.
When is the best time to enter a trade on MetaTrader 4 or on binary options, on a binary option platform? What's going on, guys? It's your boy Josh Sanchez again with yet another YouTube video. And on today's video, we're actually going to talk about when is the best time to execute a trade. I know for the most part, this is something that I actually struggled with a lot when I first got into trading. And for those of you out there who might be trying to find out when is the best possible time to enter a trade, or what times of the day is it best to even open up the charts, that's what we're going to talk about on this video, and what to actually look for, all right, when you do have your charts opened up, so you can have more confidence and get into the trades, right, at the best possible time. So with that being said, guys, let's roll the intro, and I'll see you on a few. Can we roll the intro? Can we? What? The intro hasn't. All right, guys, we are live. So let's get into it. Today, I'm excited to talk about the best time to enter a trade on either Forex or binary options, right? Either MT4 or your binary broker. So before we get into the technicalities of it, right? Because for those of you who didn't already know, I'm a technical analysis trader. So I love my technical analysis. Before we get into that though, we got to really take a moment to understand, all right, the different sessions that occur in the Forex market. Now, if you're new, all right, and this is your first time watching this video, is your first time checking out the channel, I like to take my time and really go into details of what you do need to know before you actually put your money on the table, right? Before you put your money in the market, because it's really important that we understand the different times of the day where the market is actually moving, where it's actively moving. And it's important to understand what times of the day the market is just sitting still, right? So with that being said, what we're going to do is we're going to go to forexfactory.com. It's a free website. You can check it out whenever you want. But forexfactory.com is super, super useful for a few reasons. Number one, and I spoke about this on one of my previous videos, but number one, it's useful in the sense of we're able to get news notifications for what is happening with a particular currency, right? This allows us to see whether it's going to have some sort of a positive or negative effect on the market, right? Based upon what it's, based upon what's happening. But that's not why we're on Forex Factory for today, right? We're on Forex Factory because we want to scroll to the very bottom and look at what is called the sessions tab, all right? The sessions tab is super, super important because there are 4 different sessions, okay? I almost said 3 for some reason. There's 4 different sessions in the Forex market. So like you guys see here, we have the Sydney session. That's number 1. We have the Tokyo session, London session, and the New York session. Now, before you guys look at these sessions, just double check to make sure that you are on the right time zone on your website, because sometimes you got to like readjust that, right? See, I had to click on it for it to refresh and update, but let's go back to the calendar. So just make sure you're on the right time zone, so that way you guys don't get confused. All right, so we scroll at the bottom now, and let's look for actually, let's go back to the main page. And let's go back to the sessions. There we go. All right, so right now we are in the New York session. Now let's talk about the 4 sessions. When is the market, here's the question, when is the market actively moving, right? And during what session? The Sydney session, all right, is pretty much the Aussie session, right? That's where the market is not really moving too much. The market is not as volatile, right, as it is later on throughout the day, okay? And this is usually around, like you guys see here, 7 p.m., 11 p.m., 1 a.m., so on and so forth. Then we got the Tokyo session, okay? Tokyo session is also another session where the market is not really moving too much. You may see some good movement with the Japanese currencies, the Japanese yen, you know, things like that. But USD JPY, for example, you know, Euro JPY, GBP JPY, right? But it's not going to be as, you know, volatile or as active as we would want it to be for us to be able to get in on retracements, which I'm going to show you guys in a second. Then we got the London session. The European market's pretty much open at 2 a.m., 3 a.m. Eastern Standard Time. That's where the European markets are now having more, it's fluctuating a little bit more, right? There's a lot more volatility going on. So currencies like the Euro USD, currencies like NZD USD, you know, currencies like Euro, NZD, things like that, right? They're more active, they're moving more. And that's, like I said, typically around 2 to 3 in the morning. Then you got the New York session, which typically starts at 8, 9 a.m., right? 8 a.m., 9 a.m. And that's when we start to see some movement on the dollar pairs. That's when the stock market opens up, obviously, right? And we start to see a lot more fluctuation with the dollar pairs. So USD JPY, USD CAD, currencies like that, that's when you start to see more movement. Now, the question here is what happens when these sessions overlap, right? That's the question. Because you guys will notice that, let's say, for example, London and New York, if it was 11 a.m., these two sessions would be overlapping. So when sessions are overlapping, that increases the volatility of the currencies for those times. Okay, so if we have London session overlapping New York session, that means that there's a lot more movement going on for the dollar pairs and the European pairs, okay? So there's more profitability there. There's more opportunities to get in the market when you have the two most active sessions overlapping, okay? And then when you do have Sydney and Tokyo overlapping, yes, there's more volatility, but when these two sessions are overlapping, you do not see that much movement. So for me personally, I typically trade in the mornings, right? I'll trade New York session. If I get up early, I'll trade London overlapping New York session, which is honestly fun. Okay, it's pretty cool because you do get to see a lot of movement going on. And then if I want to trade late at night, I'll probably stay up till like, 3 a.m. to start trading the London session. Okay, 2 a.m., 3 a.m. to start trading London session. And I'll see if the markets are actually giving any movement or not. So that's important for you guys to know. The two times for me, like I said, where I trade is in the mornings and late at night. Okay, 2, 3 in the morning. So that's pretty much that for the times, but please make sure you guys understand this, because understanding when to trade, you don't want to enter the market at like 4 or 5 p.m. Eastern Standard Time and there's no movement going on, because then what's going to happen is you're just going to get trapped and you're not going to make any money. And obviously we trade to make money. So now we're going to go ahead and we're going to get into the charts, baby. So let's talk about what I like to call, and again, I went over this on my last video, right? A little bit briefly, but I want to go more in depth with it on this video, because I truly think that when you understand the different times to trade in the market, and then you look for what we call levels of support and resistance, I think that that's really going to amplify your results when trading, because the reality is this, guys, trading is a game of patience, right? Or it's, I wouldn't really say a game, because it's not a game, but it does require a lot of patience. You've got to have patience, and patience builds a lot of discipline. So, and it's crazy, over time, as you guys practice placing your support and resistance, you're going to start to see it's just evidently going to just pop up in your face. It's going to be right there. It's going to be easier to see over time. But support and resistance is no more than reversal zones. So I know there's other traders out there that may refer to them as reversal zones. Other traders might just call it straight up support and resistance. I go back and forth. I call them support, resistance, reversal zones, whatever. But it's the same thing. Essentially, it's the same thing. Areas in the market where price is actually having a correction. You see, it's a little bit more risky when you're trading in a ranging market that it's constantly doing all this stuff, when you can just be waiting patiently for the market to retest. What we call, these are called retests. When we can patiently wait for the market to retest these levels of these reversal zones, right? These levels of resistance and these levels of support. So if you guys didn't already know this, we'll go ahead and call resistance the ceiling, and we'll call support the floor. So it's like that universal rule, right? What comes up must come down. So the same thing applies to the market. You have different levels in the market where price goes up, hits a certain peak, and then it has a retracement. Then it goes again and it hits that peak and it has its retracement. As traders, what we like to do is we like to patiently wait for the market to hit or re-hit these levels of retracement for us to execute our trades. So if I was to draw this out for you guys, we have the first touch here, right? We have the first touch on this resistance at the top, then the market pulls back, and then it hits that same level again. So what do we do when it retouches this level? Well, we do what it did last time. We follow what it did the first time. We execute the sell. We take a selling position, and we take a selling position with a small risk, where the risk here, right, would be right above. Let's say if we were going short, we would place our entry at the retest, and what we would do is we would set a small stop. A stop loss is your safety net when you're trading. The stop loss would be literally right above the previous high. So right where you guys see that candle with the wick, that previous wick, you would set your stop loss right above that. So if you get stopped out, you're only losing what you're willing to risk. Now, if you set your take profit, when you're setting it, you want to look for a retest for where the last level that it had a retracement at. So my take profit would be anywhere around here for this trade. So when it does come back down to the same level that it retested before, it'll take me out in profits, right? I won't be holding it and then worrying about it coming right back up to that same level again and taking me out, right? So the idea with trading is to have a small drawdown. You're looking for the smallest drawdown you possibly can have. If you get no drawdown when you're taking a trade, you are golden, right? So that's one example right there. You took the trade, let's say you hit your take profit, beautiful, right? That was a 5 to 6 risk to reward ratio, which is beautiful in trading. And let's say you do the opposite. It comes down here, hits that support level, it has a retracement, and then it hits it again. Only difference is that this time it's having it created a lower low, right? It created a new low. So let's say you got in here and you set your risk. Let's say you set your risk right below that previous wick here. Okay. You would have set your risk right below that previous wick. If you had set that risk, you would not necessarily, I mean, it depends on the broker. You could have gotten stopped out. You probably could not have gotten stopped out depending on the broker. But your target would be anywhere around here, right? Your target would be anywhere around here to take you out where it previously had a retracement at. And if you're doing something called trailing your stop, which in another video I'll talk about, then you can continue to ride the wave, right? But essentially, again, whenever you're looking for a trade, you want to be patient and wait for the market to have these corrections. Because if you're just randomly jumping in, you're randomly giving the market your money, right? So these are examples of supports, resistance. When the market hits a new high, that is a resistance. When it hits a new low, that is a support, okay? Just to keep it simple with you guys. All right, and then now the last thing we're gonna talk about is reversal candlesticks. What are reversal candlesticks in the market? These are other things that you wanna pay attention to. And I know I briefly spoke about this on my last video, but on one of my other videos, but you guys are gonna see a whole bunch of these candlesticks. So every candlestick okay, depending on the time frame you're looking at, but every candlestick has a different body, right? The bodies are the shadings in the candles, and the wicks are the sticks that are coming out of these bodies, that are coming out of the shadings. So what's going to happen is when you're getting candles that have very small bodies, very small to no bodies, and only wicks, bigger wicks, that is a signal. It's basically the market letting you know that price is due for a correction. So if we were to take a look at the top of the trend here, right? And I'm going to highlight this so it's a little bit easier to see. If we look at these candles, whoa, if we look at these candles right there, these three candles at the peak of this trend, okay, they have small bodies but larger wicks. And if we pay attention to what happened afterwards, okay, we pay attention to what happened afterwards. We reset this real quick, draw our trend line, look at the reaction that the market had afterwards, where it actually went in a downwards trend. That means that the market hit a new high, right? It came up, hit a new high, and those were reversal candles. The market corrected itself, had a retracement, bounced back up, more reversal candles popped up here, market came down. More reversal candles popped up, market came straight down. More reversal candles here, market came down. So what do? The next time the market has reversal candles around this area, logically, we would execute our selling position. Now, if we get a situation where the market does not have a correction anymore, and it actually starts to do this, it breaks out, and then it starts heading in an upwards direction, then we do the same thing that we did when it was dropping, but now we're doing it in the opposite direction. We're waiting for the corrections on the uptrend, right? On the new trend. It's as simple as that. But you want to pay attention to the candles that have small to no shading, okay, and larger wicks, because those are typically candles that are giving you the data that the market is due for a correction. So once you wait for those setups, right, you wait for the different, pay attention to the different times, the different sessions, you wait for the setups, look for your support and resistance levels, wait for the reversal candlesticks to appear, to create, to be created, and then you start to look for entries with, again, little to no drawdown and bigger rewards, right? And that's the whole idea with trading, guys. It's looking for positions, being patient, and taking positions with small risks and high rewards. So I hope this video was helpful for you guys. I appreciate y'all for sticking to the very end. And I'm excited to drop more content for you guys. I hope this was helpful. If it was, if you learned something new and this video was absolutely helpful, do me a favor, just hit that thumbs up, hit that subscribe button, leave a comment. I would highly appreciate that. And I'll see you guys on the next video. So everybody have a blessed day, have a good rest of your week, and I'll talk to you guys soon. Later.